Foreword. For the better part of 3 decades, I have been a wealth manager focused on protecting and growing the portfolios of my clients in an investing world ruled by the rival impulses of fear and greed. That term, wealth manager, also means I have been my client's psychotherapist, rabbi, crisis counselor, and cheerleader, through times good and bad, scary and giddy. I started my career with Morgan Stanley & Company and spent almost 20 years at the fabled Wall Street Investment Bank, presiding over the personal fortunes of hundreds of rich clients, tech entrepreneurs, professional athletes, and other investors. Ultimately, I shepherded the placement and protection of $11 billion in other people's money. And while that might evoke Hollywood visions of Gordon Gekko furiously trading 100 times a day, my investments had all of a 5% turnover in a year. In 2005, after a career on Wall Street, I opened my own firm in search of a better way to serve clients and build their wealth. Only now can I tell you the truth about something that has bugged me and embarrassed me for years. Finally, it is time to admit it. Wall Street wealth advisors and the bulge bracket giants who dominate the business are failing their clients. In most every way that counts, they are falling short. The financial advice business is dysfunctional, self-absorbed, occasionally venal, and almost always kind of clueless. The people who earn princely sums to manage the wealth of their even richer clients are good people who mean well, for the most part. They want to do a good job, and they believe they are doing a good job. But they are delusional. They do what their Wall Street firms have told them to do, and they have been taught the wrong things to do by people who don't know the right things to do. They haven't been trained in the most basic concepts of portfolio construction and how to measure and manage risk. They have little appreciation for some of the most important factors in managing money: risk, volatility, and cost of living increases, and they barely know the true financial needs of their clients. The stockbrokers and money managers and financial advisors who are supposed to be taking care of your money, taking care of your future and your family, have no idea what they are doing. I will say it again in a gentler way. Most people in the money management business are unknowledgeable in how best to advise you. Even worse, they don't know that they don't know. Nor do their firms train them in even the most basic rules for how to manage a portfolio. This image is exactly the opposite of what most American investors have in mind when they think of a Wall Street financial advisor, thanks to 20 or 30 years of brainwashing by soft-lens, stentorian TV commercials featuring caring brokers in pinstripes and wire-rim spectacles. The implications of this ignorance are ominous and disturbing. Millions of Americans are committing financial suicide, passively, gradually, and unwittingly. Their advisors are leading them down a path to ruin, slowly and imperceptibly, failing to shield them from the hazards of market turmoil and volatile business conditions, and unable to capitalize on shifts in investor sentiment. Thus, financial advisors across the nation are reassuring their clients and telling them, "Don't worry. It's okay. You are in good shape," when you should worry about the right things. It isn't okay, and chances are your portfolio is in bad shape. All of this makes me seethe with anger and outrage, leavened with no small amount of chagrin for any part that I might have played in perpetuating it. Nobody should go to bed unaware of the risks of what might happen to their portfolios overnight or in the future. Yet people across the U.S. are vulnerable. Their expert advisors have no idea how to assess the maximum downside risk required to get the returns necessary for them to retire in comfort and preserve their savings. In the next crash, and there always will be a next crash, American retirees will be left naked and afraid, as the survivalist reality show would put it, unprotected because most people on Wall Street haven't been trained to know any better. This has been going on for decades, and it hasn't changed. Until now. I wrote this book to save you from the bad brokers and money managers in the business, which is pretty much all of them. My aim is to shine a glaring light on the problems in the business and why they persist, and then offer you one simple, basic tool that will give you control over your investments and put your broker to shame. I want to empower you, the client, to protect yourself. Introducing the CHIP score. That simple tool is called the CHIP score, for Chapwood Investment Portfolio Score, derived from the name of my financial advisory firm. For 20 years I have been thinking about risk and volatility and how to quantify them, mulling the real increase in the cost of living compared with the real returns a portfolio earns. This tool is my answer, and I have spent many years devising it, testing it, fine-tuning it, and ultimately deploying it. You can do it yourself, and the CHIP score can empower you to fix your portfolio and reconstruct it in a way that can make it a lot less vulnerable to the next market rout. My CHIP regimen also can help you assess whether your advisor is failing in his or her basic mission to keep your assets protected and safe, yet able to grow at maximum output while assuming only moderate risk. By answering just 14 questions and data inputs, you can quantify the risk in your portfolio, gauge your returns compared with the rise in your cost of living, assess the extent of diversification and downside protection, and evaluate the true performance of your financial advisors. Everything you are about to read is true, and it may make you feel as angry as it has made me feel. The difference is that after you finish reading this book, you can do something to fix this mess. In the old days, we were known as registered reps, and later the preferred term was broker. As the once rarefied business exploded in the early 1980s into one gigantic sales machine, promoting the same kinds of financial products to all kinds of customers, Wall Street firms looked for fancier titles. The firms were forbidden from calling us portfolio managers because we had no portfolios to manage, and they hadn't bothered to instruct us in how to do so regardless. So they chose the highfalutin moniker wealth managers, even though we didn't know the first thing about managing wealth. Rather than customize a portfolio expressly for one client's particular needs, Wall Street shills opted for one-size-fits-all templates, aimed mainly at selling their firm's products rather than serving their customers. The bulge bracket firms that employ them, including Morgan Stanley, Goldman Sachs, J.P. Morgan Chase, Merrill Lynch and Company, now part of Bank of America, and a few other titans, spend hundreds of millions of dollars a year on world-class research, yet most wealth managers spend little time reading it. They focus on landing new accounts and lining their own pockets. When I first joined Wall Street, I was a young man with untested skills. My first day as a full-time broker in the Dallas office of Morgan Stanley was momentous and portentous. Terrible Tuesday, as the Wall Street Journal later would dub it, the day after Black Monday, October 19, 1987, when the Dow Jones stock average plunged 22.6% in a single day, setting off a worldwide financial crisis. It remains by far the worst decline in the history of the 200-year-old New York Stock Exchange. In the crash that preceded the Great Depression of 1929, stocks fell 12.8% in a single day. That morning, pulling up to the firm's rather unremarkable 15-story building on Ackerd Street in downtown Dallas, my overriding concern was where to find a parking space. Soon after I entered the office, something felt gravely wrong. "Oh, shit, shit, shit!" one broker shouted. That's not normal, I thought to myself, as other brokers, looking shocked and shaken, fielded calls from frightened clients. It felt like I had walked into a war zone. Later I would realize they could have avoided panicking when stocks plunged if they had adjusted properly for risk in their clients' portfolios by offsetting potential declines with other kinds of investments: bonds, gold, real estate, more exotic alternatives. In the ensuing years, as stocks rebounded and embarked on a bull market of historic proportions, both in terms of how high stocks would rise and how long the run would continue, I learned the uncomfortable truth of how the industry works. I saw how basically every firm was the same. Merrill Lynch created and patented the CMA, Cash Management Account, and everyone followed in pursuit. Merrill would come out with a new mutual fund idea, and every other brokerage firm would replicate it and sell it to all comers, no matter how divergent their needs. The better I got at the job, the more disillusioned I became with the yawning gap between how well we thought we were serving clients and how poorly we were doing at protecting them and enriching them. I felt like I was on a bandwagon. I saw lots of people doing what I did. We sat in these big fancy offices at a big-name firm, and all of us were utterly convinced that we were doing a good job. Not a single moment of our training regimen, if you could call it training, was spent on portfolio design, diversification, or risk reduction. Instead, we spent our time learning about the mutual funds, baskets of various stocks, that our employers were creating, and the fees we were charging to sell them to our clients. When clients hire an advisor, their number one priority is, take care of me and make sure you don't lose my money. And the weird thing is, nobody at the Titanic Wall Street houses ever taught us how to do that. Not really. Yet clients to this day are unaware of this weakness. When they need heart surgery, they pick the best surgeon they can find and insist he or she have the best possible training and experience. Yet blindly, they put their money in control of brokers who are untrained in how to protect them. Golden Retrievers. All these firms wanted their brokers to gather money and give it to them to manage by selling their inventory of financial products. We were golden retrievers, as a colleague once put it, unleashed to go out and gather the gold and bring it back to our masters. We did this rapaciously and with an unintentional and unknowing lack of regard for preserving our clients' wealth, although a lot of us failed to realize this at the time, and most advisors on Wall Street remain oblivious to it. We were uninformed about the vagaries of real inflation and how it eats away at investors' savings, and we were ill-equipped to spot risk, measure it, assess it, and especially offset it. Because nobody knew how to construct and manage a portfolio properly, we were also unable to devise an objective way to evaluate the effectiveness of its design. If we don't know which important things we don't know, how can we begin to know whether we have protected our clients adequately? Nor were regulators any better at this stuff. The Securities and Exchange Commission, SEC, and the industry's self-regulatory body, FINRA, the Financial Industry Regulatory Authority, lacked a specific prescription for evaluating risk and volatility, and for judging whether Wall Street firms are adequately safeguarding client accounts. The securities industry is heavily regulated, and it is heavily self-policed. But its obsessive focus on compliance exists for a sole reason: to cover the assets and asses of investment firms and insulate them from investor lawsuits. Protecting the client is, for most advisors, almost an afterthought. And if the regulators don't understand it, why would the money managers under their watchful eyes be able to understand it, much less the clients? As this realization crept up on me in recent years, I felt like the entire system I had served for 3 decades was a fraud. Clients see only one metric: whether their wealth is up and by how much, compared with the holdings of everybody else. That is only the crudest measure, and it can be an insufficient and misleading one. Just as important are such factors as, how much risk did you take on to reap the returns you reaped? Was your portfolio diversified with non-correlated assets that run counter to the broader markets? Were you able to narrow the range of possible investment outcomes to reduce volatile swings in the value of various asset classes in your account? What was your real rate of return after deducting management fees, administrative costs, and taxes? Did he keep up with the rise in your cost of living in the past year? Until now, investors have been missing a good, clear way to evaluate how well their financial advisors are doing at constructing a strong and safe portfolio, evaluating risk and reducing it, and adding offbeat, alternative investments that zig when the rest of the market zags. My new CHIP score empowers you to quantify, measure, and track those factors and more. Nobody else is looking out for you. Reject from inception the idea that your typical financial advisor can safeguard your portfolio and protect you from loss. They are unable to protect you, given that they are untrained and uninformed in how to do so. You must look out for yourself, and this book will teach you a new way and a much better way to do that.